Hey guys, this is AI Mike Zlotnik, not the real Big Mike. Thanks for watching. I love sharing what I've learned about real estate investing over the years, and I'd like to keep you in the loop. Subscribe to the channel for more of my take, and if you want to see the deals we're working on, head over to tempofunding.com.
Hey folks, this is Big Mike, Mike Zlotnik, and today's discussion is actually an advanced topic. It's for all of you who have real estate and are thinking about 1031 exchange, essentially selling existing real estate and then redeploying the money into something that is tax deferred. 1031 exchange, it's a powerful way to defer gains on an appreciated real estate property. The short version of it, there's a classic way to do this. For example, let's just say you invested into a turnkey property or multiple turnkey properties, a portfolio of properties, or a commercial building, and you've owned it for a number of years. At this point, you would like to sell it. It's very common where you have significantly appreciated asset with trapped equity and limited cash flows. Happens all the time in coastal markets. I live in New York City, California, many big cities. You see good appreciation, but if you try to rent the property out, your cash flow is very weak. So what do you do when your cash flow is weak and the property is appreciated? You could sell a capital gains, or you can try to do what is known as 1031 or equivalent. And the reason I wanted to bring up some of these ideas is because these are very powerful concepts and techniques that work like 1031, but they're not exactly 1031. In some ways, they're worse, but it's important to be aware of these options. It is not for everyone, and it's not for every deal. So there's tremendous power in these ideas. So let me go through. So you got 1031 exchange where you use an intermediary, you sell a property, you put the proceeds with an intermediary, you have specific time and restrictions, what you can roll the money into, but you typically have 60 days to select a property, 180 days to close. You can do classic and you can do a reverse 1031. The classic is where you get the funds in an account, then you select the next property, and then you close and you roll the funds into that property or properties. Reverse means you can actually buy you could buy a new investment and then sell later. So you reverse the order. Instead of sell then buy, you could actually buy then sell if you have the funds to conduct the purchase transaction ahead of the sale. So both exist, both are classic. There's a lot of education on the topic. I'm not going to spend much time. Now there's an additional technique that is used with partnerships. It's called tenants in common, or TIC, TIC. And this is when you sell your appreciated real estate, and instead of buying a new property directly yourself, you can invest with partners. This TIC structure is applicable to also syndications or partnerships where you are a limited partner, not necessarily a general partner. You could have other partners, and you can roll your 1031 money into a tenants in common structure where you own a piece of the property, and that tenants in common structure of ownership with partners, either, as I said, a regular partnership or a limited partner, general partner, syndication-like structure. You can actually use this tenants in common. Typically, tenants in common structure requires pretty significant proceeds because it's complex and expensive to set up. But in general, if you're doing significant amount, $1 million, $2 million, it may justify a tenants in common approach. Next structure is passive loss harvesting. That is an incredibly powerful way. We've done quite a bit of these type of deals. We've seen these deals work incredibly well. And it is really, really with 100% bonus depreciation coming back. Technique is incredibly simple, and most people don't even know about it. It's called passive loss harvesting, also known as pseudo 1031 exchange. So how does it work? Well, it actually works really well where you try to do a regular 1031, you couldn't find another property, you blow up a 1031 exchange, or you basically go immediately into this approach. So the approach is very simple. You basically sell an appreciated property. You just sell, and then you buy a new property where you get into a commercial deal, a commercial syndication, where there is a planned cost segregation study and bonus depreciation is computed and estimated on a given deal. So, for example, you could sell a bunch of turnkey properties, take the proceeds, and deploy it into a commercial, multifamily, open air shopping, industrial, etc. deal where you basically talk to the general partner and there's a really good estimate of what bonus depreciation will create in the form of losses on that deal. So you know your gains. The gains are called passive investment gains. Typically, if you own a property passively, the funny word for it is they're called PIGs, PIG, passive investment gains. And on the other side, when you deploy the capital in a deal with heavy depreciation, we've done these deals, we've structured these deals. You put in $1 million, you can get $2 million in first year depreciation losses, 2x ratio as an example. It depends on the deal structure, of course, leverage, etc. But in a structure where you could redeploy the funds and get heavy for $1, get $2 worth of loss, instead of doing 1031, you effectively have flexibility to put some proceeds from your sale into one of these deals and harvest these passive losses, passive allocation losses. They're called PALs. So PIGs and PALs, passive investment gains, can get offset by PALs, passive allocation losses. These are technical CPA terms, but this is how it works. And this approach has been used by many savvy real estate investors. It's an advanced technique, but it's a very simple and very powerful technique. And because 100% bonus depreciation is back as part of the one big beautiful bill, this is now back full speed ahead. Incredibly powerful, incredibly flexible. So that's the technique number two. Technique number two is DST, Delaware Statutory Trust. Some folks have used it. I've looked at it. I found it to be a little bit too inflexible and too expensive. Folks who offer these type of products, there are setup fees, there are ongoing fees, and there are limitations how the funds could be used. But it can also work under some circumstances for some investors. So DST is also a technique that has been used to do an equivalent of 1031. But today, if you're thinking about DST, you also need to think about the next item on the list, which is opportunity zone. And opportunity zone funds have been around. They the first President Trump tax bill of 2017, and then they've been renewed and extended and expanded in the new cycle starting from 2027, where there's also rural opportunity zones, a number of other ways to defer and reduce, in some cases, completely eliminate taxes. Opportunity zones is something that folks can look at. Current cycle is ending by the end of 2024, so it doesn't make sense to do anything new today until 2027 cycle starts, at least from my quick review. I'm not CPA, I don't play one on TV. Consult with your CPA professional, of course. But there's significant power in these opportunity zone deals and funds when they start the new cycle in 2027. So that's the summary of this very powerful concept, these powerful ideas that can generate investors opportunity to redeploy the capital that is stuck on existing real estate properties that they would like to sell and get their funds into something different. And again, number one on the list is the classic. People have done it for many years, continues to be a great way to defer gains and roll the funds into the next set of properties. Number two works really, really well. You could be a passive investor where you were active before, you own properties, you manage them, and now you sell them, roll the money into a partnership or a syndication, and then you harvest the losses from the cost segregation and bonus depreciation. And then you basically can focus on the deals with better cash flows versus what you're getting today. Just a consideration, why would folks do this is because it gives them flexibility how to approach the deployment of the funds that come from a sale of 1031 property that they were thinking about. This is just an executive summary of this. If you'd like to learn more, sign up for newsletters. Go to our website, tampafunding.com. Click to be on our list. We'll have more information. Schedule time to talk to us. We actually have a number of CPAs that can help you and have this conversation, which approach is right for you. What we do is we find actually deals, or we structure deals that have passive loss harvesting, significant opportunities for investors to participate in that. We're also looking at the opportunity zones in the next cycle, 2027 and beyond. We don't do any DSTs, just for the record. There's some folks who do DSTs. I've interviewed them on a podcast. Talk to them if you'd like to learn more. And then a classic 1031, there's a lot of literature on the topic. It's one of those things that you need a good intermediary. There are all kinds of options. So if you want to roll your funds through that process, you can still reach out to us. We can have a conversation, and we can certainly introduce you to a CPA who could help you with that process as well. Thank you so much. Appreciate your time and attention. Until the next time, thank you.